My name is Mike Corbat. I'm the Chairman of the Board of Citigroup. Joining me on the stage is Mike Corbat, CEO of Citigroup. On behalf of the rest of the Board of Directors, we're very pleased to welcome you to the 2017 Annual Meeting of Stockholders. I'll serve as chairman of today's meeting, and Rohan Weerasinghe, our General Counsel and Corporate Secretary, will act as the secretary of the meeting. A few years ago, the board decided to alternate our annual meetings between our headquarters in New York City and other cities integral to Citigroup's businesses around the country. We're happy to be hosting our meeting in New York City this year and returning to one of the city's finest institutions of higher learning, Cooper Union. We also extend a warm welcome to our stockholders who are participating in today's meeting through our audiocast. This time, I'd like to introduce the members of our board of directors who will be standing for re-election. Their backgrounds and qualifications are described in detail in the proxy statement you received. In addition to Mike and myself, our current directors are Ellen Costello, Duncan Hennis, Peter Henry, Franz Humer, Jean McQuaid, Gary Reiner, Tony Santomero, Diana Taylor, Bill Thompson, Jim Turley, Debbie Wright, and Ernesto Zedillo. Mr. Weerasinghe. Forgot Mike Corbat.
And Renee James.
And Renee James. There she is. All right, good. Thank you.
Thank you, Mr. Chairman. I am pleased to report that all legal formalities for this meeting have been met and a quorum is present. I would like to remind you that today's presentation may contain forward-looking statements which are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual results in capital and other financial condition may differ materially from these statements due to a variety of factors, including those in our SEC filings, including without limitation the risk factors section of our 2016 Form 10-K. At this time, I would like to review for the stockholders the agenda for today's meeting. An agenda and the rules of procedure for this meeting were placed on your chair before the meeting, or you obtained it when you came in. We will begin by having our CEO, Mike Corbat, give his State of Citi presentation. At approximately 9:30, we will turn to the business portion of the meeting, the proposals to be considered. The proxy statement you received for today's meeting describes 9 matters to be voted on. As described in the agenda for today's meeting, we will begin with the presentation of the 4 management proposals. In order to be sure that stockholders are able to ask questions about all of the management proposals, we will introduce all of them at once. You will then have an opportunity to ask questions about any of the 4 management proposals brought before this meeting. This process is designed to maximize the amount of time for discussion of stockholder proposals and for stockholders to be able to ask questions about the company during the general Q&A session at the end of the meeting. No later than approximately 10 o'clock, we will conclude the discussion of the management proposals and discuss the stockholder proposals. Each stockholder proponent will then present his or her proposal, and you will have the opportunity to ask questions after each one is presented. General questions about the company should be asked during the Q&A session later in the meeting. No later than approximately 10:30, after the presentations of the proposals, we will collect the ballots and close the polls. While the votes are being counted, you will have the opportunity to ask any general questions about the company. No later than approximately 11:30, I will report on the vote and the meeting will be adjourned. As a courtesy to your fellow stockholders, I would remind everyone to turn off all electronic devices. In accordance with the procedures for this meeting, photographing, recording, or videotaping these proceedings are prohibited. Thank you, Mr. Chairman.
Thank you, Mr. Weerasinghe. Our CEO, Mike Corbat, will now give a presentation on the state of Citi. Mike?
Thank you, Mr. Chairman. and good morning to my fellow shareholders who join us here today, both in New York and by audio cast. First, it feels great to be speaking to you again from the Great Hall of the Cooper Union, an historic 160-year-old building about 2 miles from our headquarters on Greenwich Street. My management team and I moved there early last year, making a return to our roots in Lower Manhattan after nearly 60 years in Midtown. Second, it feels fitting to be here because the mission of the Cooper Union, which is to prepare talented students to make enlightened contributions to society, is so consistent with Citi's core mission of enabling growth and economic progress. Peter Cooper, the inventor, investor, and innovative philanthropist who founded the Cooper Union, was the son of a poor hatter who amassed a huge fortune despite the disadvantage of having just 1 year of formal education. Cooper founded and funded this unique institution with the goal of helping other young men and women of all races, a radical idea at the time, gain the sort of practical education he'd picked up independently. With the Citibank of New York, our name back then, Cooper helped finance the laying of the first transatlantic cable and the construction of the Panama Canal. Today, in honor of that nearly 200-year-old partnership between two great New York institutions, I'd like to thank Cooper Union's current president, Laura Sparks, for hosting us here today. Laura is a Citi alumna who, during her career at our company, worked to develop programs to increase affordable housing and eliminate barriers to opportunities for New York's low-income families. It's entirely keeping with our mutual mission of enabling growth and economic progress for all that at Citi we recently announced the international expansion of our groundbreaking Pathways to Progress program, with a goal of helping 500,000 young people inside and outside the U.S. gain the skills necessary to compete in a 21st century economy. Our commitment to New York extends beyond the fact that we have our global headquarters here, or that we have more than 17,000 employees and over 25,000 alumni in the metropolitan region. Since our first founding, not far from here, more than 200 years ago, we've been a leading financier of infrastructure in this city and in this state. Last year, we helped finance the redevelopment of the Central Terminal at LaGuardia Airport, and before that, the construction of a new Tappan Zee Bridge. Just last year, we financed nearly 10,000 units of affordable housing in New York City, and we were ranked the #1 financier of affordable housing in the U.S. for the 7th year in a row. These are compelling examples of the critical role Citi plays not just in New York, but across the country and world in helping public and private sector entities raise the funding required to build, repair, and replace aging infrastructure. At a time when so much infrastructure in the U.S. and the world is in dire shape, transformative transactions like these have a significant, positive, and well-documented multiplier effect on the broader economies of the world, communities, and regions. Infrastructure projects, when properly designed, tangibly spur growth, create jobs, ignite innovation in a virtuous circle that lies at the heart of what we do at Citi every day. I highlight all this because, to my mind, too many people and too many countries still don't appreciate the catalytic impact that we and companies like ours can have on the millions of lives and people and communities that we serve. Just think of what kind of world we would live in if the founder of the Cooper Union and the founders of Citi had failed to pursue their grand, yet at the time, widely ridiculed ambitions to stimulate trade between the U.S. and the rest of the world, laying a transatlantic cable and building the Panama Canal. Still, those of us who have benefited materially from trade and its cultural cousin globalization can't ignore the fact that trade and globalization haven't spread their dividends and benefits as widely or as evenly as they could or should. We need to work even harder with both the public and private sectors to make sure that what we do every day helps even more people gain economic security than it does now. Now, if I can, let's turn to our financial results for the year. I'd say that it's no exaggeration that 2016 was an extremely eventful year for our company, our country, and the world. As the year progressed from one with a first half that was defined by economic anxiety and volatility to a second half that was clearly impacted by a series of political upsets and surprises, at Citi, we demonstrated the resilience of our unique global franchise. Our support and advice helped millions of customers and clients around the world navigate an environment that turned out to be far more challenging than anticipated. The nearly $15 billion of net income we earned in 2016 was a reflection of the momentum that we'd built across many of our core businesses over the year, even as we made the investments needed to spur growth. Among the many milestones we marked on the road to achieving our ultimate goal of being an indisputably strong and stable institution, I'd like to highlight a few. First, in our consumer bank, we continued to focus on our footprint with the announcement of our plans to divest our businesses in Argentina, Brazil, and Colombia. We made those difficult decisions to concentrate our finite resources on our three major consumer markets: the US, Mexico, and Asia. In the US, one of the highlights of the year was the conversion of 11 million Costco card customers to our platform in June, and then adding an additional 1 million new cardholders over the next 6 months. We also extended a nearly 3-decade-long relationship with American Airlines and renewed an important partnership with the Home Depot. And in Mexico, where we enjoy the benefits of scale and a strong market position, we rebranded our franchise Citi Banamex and embarked on a $1 billion investment program aimed at modernizing our branches, upgrading our technology, and we maintained that investment while reaffirming our long-standing commitment to our North American neighbor and confidence in its growth prospects. We also made progress in our consumer bank, meeting the evolving needs of our customers by accelerating our mobile-first digital strategy. Our fintech unit spearheaded the first mobile app combining banking with wealth management and money management, demonstrating not just the strategy, but the agile methodology we use to move innovation to markets quickly. And in Asia, we entered into promising partnerships with the ride-hailing platform Grab, hospitality pioneer Airbnb, and the Lazada Group, a leading e-commerce site. In our institutional business, we continued to gain market and wallet share, with our target client revenues rising 10% in total for the year for fixed income and for equities. Our industry-leading Treasury and Trade Solutions business, the largest proprietary closed-loop mover of money in the world, generated year-over-year revenue growth for the 3rd consecutive year, despite the low interest rate environment. And our #1 ranking in the Greenwich Associates survey confirmed we remain the clear leader in fixed income. And I'm proud to add that our market shares in both fixed income and equities have risen to our highest points since the crisis. Our bankers further distinguished themselves by advising on 10 transactions worth $140 billion in a single week and being named Bank of the Year by the influential International Financing Review was another recognition of our industry-leading position. As importantly, we continue to make progress in our journey to being a simpler, smaller, safer, and stronger institution. With non-core assets and Citi Holdings now down to just 3% of our balance sheet, we announced that we would no longer report holdings results separately after the 4th quarter of last year. The significance of that announcement cannot, in my view, be overstated, considering that at its peak, Holdings had more than $800 billion in assets and was capable of producing multi-billion-dollar losses in a single quarter. In contrast, Holdings' final quarter was its 10th profitable one in a row. The passage of Holdings into history signals more clearly than in any other event that I can think of that to a significant degree we have put the crisis behind us. Yet another sign of that, we can now focus more on our future than on the past, and we welcome the announcement that we were the only one of the 8 U.S. banks determined by the Federal Deposit Insurance Corporation and the Federal Reserve to have no deficiencies in our resolution and recovery plan. We also made tangible progress generating the kind of returns you expect in reserve. In 2016, we returned nearly $11 billion in capital to you, including the impact of the incremental increase of $1.8 billion we announced in November. All those milestones and achievements support what constitutes our boldest headline of the year. Our restructuring is over. And what I mean by this is that we've returned to our roots as a globally focused bank with just 2 businesses, which are appropriately scaled to serve with distinction a discrete set of customers and clients. We define those core customers and clients as those most likely to benefit from our unique global network and footprint. And we continue to believe, with persuasive evidence to support it, that our model is the right one at the right time to perform well in this current environment. Yet despite those very real accomplishments and signs of progress, we recognize with respect to the goals and targets that we set for ourselves a few years ago, our performance last year fell short. Specifically, our net income dropped from $17 billion in 2015 to $15 billion last year. Our efficiency ratio rose to 59% from 57%, and our return on assets decreased from 95 basis points to 82 basis points last year. And our return on tangible common equity declined from 9.3% in 2015 to 7.6% last year. Why? Mostly because last year, despite the volatility and the turbulence we saw in the markets, we decided to push ahead with previously announced plans to make targeted investments in cards and equities, Mexico, and Treasury and Trade Transaction Services, Citi Gold, and the much-needed infrastructure and technology across our franchise. And again, we saw smaller gains on asset sales in Citi Holdings, which further reduced our top-line results. That said, we have a clear path to producing better returns in the future, and we divided that path into 3 drivers that lie mainly within our control. First, our raw earnings power. The first driver mainly consists of our client engagement and wallet share growth, combined with the monetization of our investments, while continuing to improve our efficiency through simplification, digitization, and expense discipline. Second, our capital base optimization. The second driver mainly consists of continuing to wind down our non-core assets, continuing to utilize our deferred tax assets while reducing the amount of capital we need to support them, and continuing to return as much regulatory capital to you as we can above the amount we need to prudently operate and invest in our business. And third, our operating environment. The third driver mainly consists of the expected upward trajectory of the federal funds rate, which has been gradually rising as predicted this year, with one additional rate hike and at least one other regarded today as likely. Earlier this year, we backed up our conviction that we can and we will execute strongly against all 3 drivers by laying out updated financial targets, including a 10% return on tangible common equity, excluding our deferred tax assets in 2018, rising to a 10% return on tangible common equity, including our deferred tax assets in 2019, and we believe we're capable as a franchise of generating a 14% return on tangible common equity over the longer term. Fortunately, our recently announced first quarter results reinforce that conviction. A little less than 2 weeks ago, we reported earnings of $4.1 billion, or $1.35 per share. We carried momentum in many of our businesses from the end of last year into the quarter, leading to significantly better performance compared to 1 year ago. We grew loans and deposits and achieved an efficiency ratio of just under 58%, a return on assets of 91 basis points, and a return on tangible common equity, excluding our deferred tax assets, of over 10%, all in line with the near-term targets I just mentioned. Turning to our two core businesses, in global consumer banking, our U.S. cards business continued to benefit from the acquisition of the Costco portfolio, although we did see lower U.S. mortgage volumes and revenues. Internationally, we again posted revenue growth and positive operating leverage in both Asia and Mexico, and we continued our investment plan in Mexico to drive improved efficiency and returns. Our institutional business also enjoyed a strong quarter all around, as we continued to gain both wallet and market share across our targeted client segments. Our markets business performed very well, with revenue up 17% year over year, comprised of a 19% increase in terms of fixed income and a 10% increase in equities, another area we've been strategically investing in. From a capital planning perspective, we utilized another $800 million in deferred tax assets, contributing to the generation of $5.5 billion of regulatory capital in the quarter before returning $2.2 billion to our shareholders. We increased our tangible book value per share to $65.94, 5% higher than a year ago and 14% higher than 2 years ago. And we raised our common equity Tier 1 capital ratio to 12.8%. And that means clearly we have excess capital, which we couldn't be more committed to returning to you at the earliest possible opportunity. When we submitted our capital plan for the 2017 CCAR cycle recently, you can be sure we made the case that we've made good and steady progress in strengthening our firm. So, as we continue to boost both our core business and see the positive results of investments we've been making for growth, our confidence in the viability of our global model and network has, if anything, only increased. Our global network is uniquely situated to helping our clients, many of which are here in the United States, and non-U.S. multinationals we serve in dozens of countries, navigate the current environment, whether through supply chain optimization, our advisory capabilities, or trade finance. That means we have the right model, the right strategy, the right customers and clients, and the right people in the right places to meet our updated targets. And in you, we have investors who appreciate the power and promise and potential we have to become the world's best global bank. Yet, if we're going to realize that ambition, we must demonstrate that we're continuing to fulfill our mission of enabling growth and economic progress. In support of that goal, I'm proud to say that we've made significant progress toward our $100 billion environmental finance goal, with $26.3 billion recorded in 2016. And because we're on track to achieve that goal this year, according to how we've been tracking our activity to date, we've challenged ourselves to redefine what completion means and have adopted a league table-based methodology that counts only Citi's share of a transaction as opposed to total deal value. Applying this new methodology, our overall environmental finance activity since 2014 comes to $41.2 billion, and these measures reflect both our commitment to addressing climate change through our business activities and a willingness to learn and adapt to the field of environmental finance as it continues to evolve. In conclusion, I can say honestly that in my 5th year as Citi's leader, I couldn't be prouder or happier to work for a company that goes to such lengths to fulfill its mission and value proposition to responsibly provide financial services that enable growth and economic progress. After almost a decade of transformation, I'm happy to report that as of April 2017, Citi is in a position to scale new heights. And I couldn't be more grateful to everyone here and around the world for supporting us on this journey. Thank you for the opportunity to share these thoughts with you today.